Nilesh Shah from Kotak AMC joining us here on the show. Hi Nilesh, this is Nantara. Many thanks for joining us. We saw a massive gap down opening. The markets have recovered. We're seeing a similar kind of recovery pan out on Mint Street as well. My big question to you is, and I'm sure this is what the viewers want to know about, so much volatility. There was talk earlier in the day on social media. Are we going to be entering a bear market with similar chatter going on Wall Street as well? How should one navigate through this market, through these times of uncertainty, especially since we don't have a full-time RBI governor? And look at the election results that are pouring in. It's disadvantaged BJP.
So one, in terms of RBI, we must remember that it's an institution, it's not an individual. Over the years, we had one distinguished governor after another, and it will be important if government quickly announces a person whose credibility and capability in leading RBI forward is not doubted by the market. Obviously, there has been fair amount of volatility, but if one wants to look at from a positive mindset, then despite all the negative news is bunching up together from RBI Governor resignation to election results, we have seen market nicely holding back. That probably reflects the fundamentals of the Indian economy and Indian market. If with all this bad news market is not breaking but recovering, that should give some confidence to optimists and bulls that bear market is not yet ready to begin in India.
You're doing alternate. You told us to decide.
Okay, Nilesh, hi, it's Karunya as well joining into the conversation. I just want to understand, how are you reading into the macro scenario right now? Because, of course, there's been a fair amount of easing as far as the rupee is concerned, as far as the crude oil prices are concerned. Of course, those are providing a lot of comfort right now to the markets, but there's still a lot of uncertainty that does persist, and the sudden resignation of the RBI governor also adds fuel to the fire. Over the medium to long term, how is it that you are expecting the macros to shape up, especially on the domestic front?
So a lot will depend upon how we capture the opportunity. And let me give you one small example. In 1984, India and China were of similar size. Today they are 7 times bigger than us. They become manufacturer to the world. We remain left out. Now with US-China tariff war, Chinese exports into US is getting taxed heavily. Their suppliers are shifting their bases into other countries. 2 of the largest buyers of Chinese goods in US are Amazon and Walmart. They in their lifetime won't get entry into China, but we have openly welcomed them. If we can convince them to buy goods from Indian manufacturers rather than Chinese manufacturers for giving access to 1.35 billion people market, India can catch up the train which we left out in the 80s. We can also become manufacturer to the world, of course not of the same size of China immediately, but we can begin that journey like China started in 80s. If we do that, it is Y2K of manufacturing, like Y2K did to IT sector. So it will all depend upon how we capture these opportunities and how we convert those opportunities into growth. As you correctly mentioned, oil prices have declined against all expectation. US Fed has reached below neutral rate, so there won't be too much of rise in US interest rates. Rupee has stabilized, interest rates have come down in India. So there are lots of factors which have come together to support the growth recovery which we witnessed in December 2017 quarter all the way up to June 2018 quarter, and hopefully these factors coming together can again start pushing growth on the higher side.
Nilesh, I wanted to get your views in once again with the resignation of Dr. Urjit Patel. How would fund managers, how will the markets now approach pockets which have been troubled? Let's talk about NBFCs. Let's talk about private banks. This has been one of the biggest sticky points between the government and the governor, and which really led to the clash. Does it call for a re-rating, or should one just wait for some stability, the new governor to be announced, see what direction the policy takes, or even just wait for the 14 December meeting? What should one do? Like for example, I look at Yes Bank today, it's up 6%, and that's perhaps a knee-jerk reaction as well, because it was known what the governor's views were when it came to the incumbent CEO of the bank.
So it's a very, very tricky question. And my simple one-word answer will be just stick to the fundamentals. The fundamentals does not necessarily change by a big margin just because some of the surrounding environment changes. So our focus right now on financial services space is to focus on steady eddy retail focused private sector banks. We have also started adding positions in corporate focused private sector banks, as we believe NPA cycle is coming to an end. In the NBFC and PSU banking sector, we are extremely selective. In NBFC sector, we want to invest with those NBFCs where asset liability management is better, where governance related concerns are not there, and where liability franchises have developed so that they will be able to fund their growth. The entire NBFC sector today will face the question of growth momentum. They were able to grow at 35-40% in the previous environment, but going forward to maintain that growth momentum will be difficult for most of them. So within the growth derating, you want to pick up NBFCs on a selective basis, on a stock specific basis.
Okay. You were just pointing out about the fact that macros are definitely improving and stabilizing in a at least comfortable sort of a zone. But, while they may not be indicating to any kind of a significant downside, but what's also difficult, what we have sensed in the last couple of months in the market is there's no trigger for a significant upside either. So what are some triggers, or what are some factors that one can actually watch out for in a market like this in order to bet on any company or any space or any sector for a decent sort of a growth going ahead?
So couple of things. One, you must lower your return expectation, because we have moved from double-digit inflation era to lower single-digit inflation era. In those days, nominal return of 20% would have translated into 7-8% real return. That was possible. Today, to maintain that 7-8% real return, your nominal return will be no more than 12%. So in some sense, people have to readjust their return expectation. Second, if you look at the broad market, it looks like as if earnings haven't moved, earnings haven't improved. But you take out some of the NPA cleaning up done, some of the sectors like telecom where competition has been intense, then overall profitability growth in rest of the sectors has been reasonable. It is not as subdued and depressed as headline numbers indicate. So you have to be stock specific. Third, today if you look at small and mid cap stocks, from their lofty valuation in Jan 2018, they have corrected quite reasonably. Many of the small and mid cap companies today are available in a fair band of valuation. These are the companies which are nimble, and they will probably go and capture the opportunities which is being provided in the global market as well as domestic market. The other important thing is that between 2013 to 2017, rupee had appreciated from 68 to 63. It, at least in the later part, make it overvalued, which impacted exports, which allowed Chinese dumping. With rupee at 72, hopefully exports have become more competitive.
Yeah.
Dumping probably would have stopped or reduced. Combination of that creates huge opportunity in small and mid cap stocks.
Okay, Nilesh, that's the sound advice coming in for all of our viewers. Nilesh Shah, Kotak, only on your channel with his views on how it is that you should be navigating through this uncertainty. Always a pleasure chatting with you. Many thanks for joining us on this Tuesday's edition of Markets at Lunch.